Wealthy people love owning real estate. And the reason why is because not only can you grow your wealth with real estate, but it gives you the opportunity to keep your wealth and it allows you the opportunity to earn some income on your wealth as well. There are three main reasons why wealthy people love owning real estate. Number one is you get cash flow. Number two is you own a hard asset. And number three is, well, you also get some tax breaks. And I can tell you this as an attorney who's not your attorney. Now, if we start by talking about the cash flow side, the way that you invest in real estate correctly is you go out and you buy a property, but you're not buying it for you to live in yourself. You're buying it to rent out to somebody else. And if you do it properly, now this income that you're getting from rent, whether it's from somebody living there or a business using your property, this rent should cover all of your expenses, your property taxes, insurance, your maintenance, your management fees, and your vacancy costs, and then cover your debt costs if you have any, and then put some money in your pocket. That's a proper cash flowing real estate deal. Secondly, when it comes to owning a hard asset, the advantage of real estate versus something like a stock is now you own something that you can see, feel, and touch. If you go and buy one share of an index fund or an ETF or a mutual fund, or you buy a share of a company, you just own a paper certificate saying you own some ownership in this thing, but you don't actually own anything. Versus with real estate, you own the bricks, you own the windows, you own the land. So you own something that you can see, feel, and touch, which gives you a little bit of a security with that. And the third thing is the tax breaks because, well, in the United States, the tax code has some of the biggest and best tax breaks available to real estate investors, which allows some real estate investors to generate an income and pay little to no money in taxes legally. Now, when we talk about actually investing in real estate, you have to know how to invest in real estate and get started in real estate. And what I want to do in this lesson is talk about some of the things you need to pay attention to, especially when it comes time for you to go and invest in real estate, whether it's your first deal, your fifth deal, or your 25th deal. And there are three general things I like to look at from broad to narrow. I like to start by taking a look at the area, the location. Number two, I want to take a look at the property. And number three, I want to take a look at the numbers. So starting with the area, this starts now with which country do you want to invest in? What state do you want to invest in? What city do you want to invest in? And then what neighborhood do you want to invest in? And in order to do this analysis, this really comes down to now, well, what's accessible to you and what regulations will allow you to invest in real estate and get the best returns? Because what you'll see is that some countries are more landlord friendly versus tenant friendly. Some states are more landlord friendly versus tenant friendly. Some cities are more landlord friendly than tenant friendly. And even then when you get into the neighborhood, some neighborhoods within the same city are going to be better suited for you as an investor and others will not. So this is where, yes, it's easier to start with what's around you, but you want to ask the question of what areas do you want to be investing in? And more particularly, the important thing for me is when I go out and I invest in real estate, I want to look at where's the money going? Because people move to where the money is going to. And if people are moving into the neighborhood where you are investing, that's not only going to allow you to raise the rents, but it's also going to allow property values to appreciate because the demand is going to rise. The prices of anything, whether it's real estate, rental prices, stocks, it doesn't matter, is dependent on supply and demand. And when you have more demand, meaning more people that want to be here than supply, well, that's going to allow your rental prices to go higher, which means you can make more money. So you want to look at where the money is going. And one of the simplest analysis that you can do is just taking a look at the populations of a neighborhood or a city that you're thinking about investing in. Go to Google. Search the population of Manhattan, and you'll see a chart showing you how the population of Manhattan has changed over the years. I like to invest my money in places where the population is stable or growing because if the population is decreasing, that means the demand is also decreasing because there's less and less potential tenants out there that would like to live in or use the space that I have. The second thing is just driving around and taking a look at what businesses are doing and do businesses want to come into this area. And in addition to that, talk to the people and see if people want to live in this area. So starting with the business side, drive around and walk around. You have to also walk around because you're going to learn a lot more by walking than just by driving. But when you're walking around and driving around the neighborhood, take a look at the buildings. Do you see buildings that are going out of business, businesses that are shutting down, things that are getting boarded up? Or do you see more signs saying coming soon, new business coming soon, we're breaking ground in the next 3 months? And if you see more and more businesses that are coming soon versus businesses that are shutting down, well, that's a good sign. If you see more businesses that are shutting down, well, that's more of a negative sign. And then I want you to do what I like to call the coffee test, which is now go to a local coffee shop, spend $5 buying a coffee, but then talk to the people that are working in that coffee shop and ask them, number one, do you live in this area? And if you do live in this area, do you like it? And if you don't live in this area, why don't you? And what you're trying to see is if people live here, do they enjoy living here? Because if they say, yeah, I love this area. There's some awesome restaurants, some cool nightlife, some cool things to do here. I really like it. That's a good sign. If they say, yeah, I live here, but there's a lot of crime happening and I'm thinking about moving out, that's a bad sign. If they say, I don't live here, but I want to live here, that's a good sign. If they say, I don't live here and I would never want to live here, that's a bad sign. Talk to people. You can spend thousands of dollars purchasing investment reports and ideas on where to invest your money, but the best resource available to you is just your feet and your mouth. Walk around and talk to people because that's going to tell you what people are doing and what people want to do. And just go to a couple of different coffee shops and get the general consensus about how people feel about this particular area and neighborhood. The second thing that you want to take a look at is the actual property itself. Once you find a good area that you want to invest, you find a few neighborhoods that you consider investing your money in. The next thing is taking a look at the property. Is this building, this property, this house, whatever it might be, is this property a good investment or not? Now, assuming you are not a professional licensed contractor, you want to get a professional to help you with this. That means when you find a good property, number one, just walk through it and see, is this something that you can work with or not? And even if it's in rough shape, that's okay. I actually prefer working with properties in rough shape, but what you want to know is exactly how many issues are in this property itself. So one of the things that I will always do before I close on a property, before I actually purchase a property, is I will pay a private property inspector to come through the property. This is after I enter into a contract to purchase a property. But I'll pay this inspector to walk the property with me. That way, he or she can give me a full report of what's going on the property and all the issues in the property. So if I get a report saying, yeah, there's a bunch of cosmetic issues, that's good. If I get a report saying, there's a lot of fundamental issues in the property. This property is falling apart. The foundation is crumbling. The roof is about to cave in. Okay, that's a much bigger concern. And now, is the price of this property justifying all the risks that I have to take? And the reason why I will never purchase a property now without getting my own private property inspector is because there was one property that I purchased, only one, that I bought without getting a private property inspection done. And the reason why I bought this property was because I was working with a contractor who told me he was licensed. I later found out he was not licensed, but he told me about this property that was a great deal. And if I was able to buy this property, we could get it flipped and turned around very quickly and make a lot of money either by renting it out or by selling it for a profit. And I had worked with this contractor who I thought was licensed for a couple of deals. And so I trusted him and I purchased the property. And I told him that I was considering getting a private property inspection. And he said, no, don't worry about it. I already walked through the property myself. We're all good. Big mistake. So I bought the property. I paid the contractor some money to do the work. He ran away with the money. What I found out later on was that he just wanted some money because he was dealing with his own financial difficulties. But now I was stuck with this property that I was told was in good shape, that I didn't get a private property inspection on. And that was when I found out that there were a lot of issues in this property. And they are way too long for me to go over in this lesson. But just to give you a little brief synopsis of it, one of the first things that we found out was that water wasn't draining out of the property. We turned on the sinks and we tried to flush the toilets, but water wasn't leaving the property because apparently somebody who was living in this property before we bought it got angry and they poured cement down the main drain. Yep, I guess people do that. So now in order for us to get water and sewage to leave the property, we had to bust out the cement from the property to the main water line and the main sewage line and redo all of the plumbing. That wasn't cheap. We also found out then, when the city inspector came out, that we had to raise the property. I didn't know that you could raise properties. And it turns out you can. It's not cheap. There was a lot of issues with this property. It was the worst real estate deal that I had ever done. In fact, it's the only deal to date that I've ever lost money on. And I even made a video about it on my YouTube channel. It's called My Worst Real Estate Deal Ever or something along those lines. But the reason why I'm telling you this is because you always want to get a private property inspection because that private property inspector's job is to make sure you know exactly what you're buying. So number one, you take a look at the location, because you can change everything about a property except its location. So that location is very important. Number two, you're going to take a look at the property and make sure that this property is not falling apart and that you understand the risks of investing in this property. The third thing that you want to take a look at are the numbers. You take a look at the financials to make sure that this deal is going to make sense for you. Meaning, if you invest $100, $1,000, $100,000, $1 million, $10 million into this deal, how much return are you going to get? And is that return enough for you? And what you'll see is that this return is going to vary neighborhood to neighborhood, city to city, state to state. And what you have to come up with is, what type of returns are you looking for? Cash flow returns as an investor. And is that return justifiable in the area that you're investing? For example, in the United States, states in the Midwest can give you much higher cash flow returns than something like Manhattan or Los Angeles. So when I go out and I invest in real estate, generally, what I'm looking for is a 7% cash on cash return, which means if I'm investing $100,000 to go out and buy a property of my own money, $100,000 leaves my bank account, I want $7,000 worth of profit every year at the minimum for me now owning this property. Again, I'm not looking at appreciation. When I go out and invest in real estate, I don't care what's happening with the prices of real estate. I'm looking for the cash flow because I can get a much better gauge of that cash flow. And the way that I calculate this cash flow is I take the potential rent. You can talk to a realtor, talk to a property manager to get an idea of what the potential rent will be. So I take the potential rent and then I subtract the expenses. That means property taxes, insurance, maintenance, management. I have a property manager that manages all my deals. I do not want to manage it myself. And even if you're managing the deals yourself, which I don't recommend you do, but if you are managing the deals yourself, make sure you add in a management fee anyways. So property taxes, insurance, maintenance, management, and then vacancy. Add this in as well, because I don't care where you're investing. At some point, you're going to have this property be vacant. So you want to factor that cost in as well. And this is going to give you what's called your net operating income. Now, if you have debt, you can subtract those debt costs as well to give you your profit. But this is how you calculate how much money your property is making. Now, if you want to go a little bit deeper, if you're thinking about investing in commercial real estate, I want to tell you about something called the cap rate. Cap rate is the term used to measure the returns from commercial real estate deals. And what cap rate means is, if you were to go out and buy a property all cash, what is the cash on cash return? And the way that you calculate that is you take the net operating income. So you take the revenue minus the operating expenses, like I just talked about, property taxes, insurance, maintenance, management, and vacancy. Take the revenue, subtract the operating expenses, which gives you the net operating income. We're not taking a look at debt. You take the net operating income and you're going to divide that by the purchase price or the property price. And that's going to give you your cap rate. So a cap rate of 10 means that you're getting a 10% cash on cash return on this property, assuming you bought the property all cash. So if you're buying $1 million property, that's a 10 cap. That means this property would generate you $100,000 in positive cash flow net operating income after paying for the expenses, not taking a look at debt, assuming you bought the property all cash. Now, this is where you want to make sure you do your own analysis and making sure that the cash flow works for you. But let's go through some numbers. That way you can kind of see this play out for yourself. So now the important part for you is to think about, well, what types of returns do you want? And can you get those types of returns in your area? The general rule of thumb is the higher the return, the higher the potential risk. That's why in areas like Manhattan or the busy parts of LA, you're going to see very low returns because there's very little vacancy there. There's always the demand for people that want to live in these places, which is why your cap rates, your returns are generally lower versus other places that have less demand. You can get potentially higher cap rates because, well, the vacancy might be a little bit higher. And this is where now you can start doing your research to see what types of returns you need and then how you can maximize those returns by increasing the value in the property. That way you can lower the vacancy. Because if you can make your property an attractive place to be, well, that can help entice tenants to want to stay, live in, and use your property as opposed to somebody else's. So now when you go out and you start analyzing real estate, yes, real estate is great because you can get cash flow, you own a hard asset, and you can get some tax breaks because there's a lot of tax breaks associated with real estate. And the best way to figure out which tax breaks to get is to talk to an accountant in your area because, well, there's so much tax law and tax stuff associated with real estate that you want a professional helping you through that. But then when you're doing an analysis of trying to find a good real estate deal, I like to follow those 3 steps of going big to small. First, by taking a look at the location. I want to see where the money is going, and I want to see where people are going. Then I take a look at the property itself. I want to make sure that if I'm investing into a distressed property, that's okay, but I want to know all the risks associated with it before I go out and actually spend the money because, well, if I'm putting my money into it, I want to know what I'm actually putting my money into. And the third thing is I want to make sure I run the numbers and make sure that I can get the cash flow that I'm looking for, because when I invest in real estate, I'm looking for cash flow. I'm not investing in real estate for what this property might be worth in 3 years. That's speculating. To me, that's gambling. I want to invest in a property and generate cash flow month after month after month, and I can get a much better estimate of how much cash flow I'm going to generate versus how much a property might be worth in the next 3 to 5 years. What I'd like you to do now after this lesson is I want you to go onto the internet and find at least 3 properties that are available for sale. Whether it's commercial deals, single family homes, condos, it does not matter. I want you to find at least 3 properties that are available for sale today. And I want you to run through the 3-part analysis. Number 1, what about the location? Is the population growing or shrinking in this area? Are there businesses moving into or out of this area? Yes, this might require you to get out of the house and drive around the area, maybe even walk around the neighborhood. The second thing that I want you to do then is to look at the properties. Now, this is going to require more work. And if you want to get inside, you're going to have to schedule a showing, but you can still take a look at the pictures to get a general idea of what is the current state of these properties. Is this one of those investor specials, meaning it needs work? Or is this a turnkey property, meaning it's ready to go? And then once you do that, I want you to also run the numbers. Now, again, this is not going to be perfect, but just get started and practice running the numbers. If you see a property on sale, well, how much can you rent it out for? Start doing the research yourself. What is the rental rate for properties like this in that particular neighborhood? What are the general expenses like? Find the property taxes. How much is the insurance? How much would the maintenance cost be? How much would it be to manage the property? And what will the vacancy factor be? Do you want to just put in 1 month worth of vacancy, 2 months worth of vacancy? What is that factor? Then generate the net operating income and see, is this property generating positive cash flow? If so, what types of returns are you getting? And again, you can go through the workbook to help guide you through this and share the things that you're working on in the community.